we're starting with Chapter 10, Static Exercises, number 17. Okay? So the great thing is we're starting off with something fairly easy. Okay? So let's take a look. We've got the Schlitterbahn Waterslide Company issued 25,000 10-year 5% $100 bonds on January 1 at face value. Now the one slightly oddball thing about this is it's a $100 bond. Okay? Then it says interest is payable each December 31. Now, before we start, here's the one thing, the one error that I see most often when we're talking about bonds. So, nail your feet to the floor on this one. The amount of interest that we are paying on these bonds, the actual cash payments, is the 5% times the stated value of the bond. So it's the stated rate times the stated value, face value of the bond. So in this particular case, how much are we paying in cash on each of the interest dates per bond? $5 per bond. Okay? That does not change. So make sure that it's like, if nothing else sticks, that's the one thing that needs to stick. All right? So then it says, in item number A, it says, record the issuance of these bonds on January 1. So a couple of things that are going on here. One, they're being issued at face value. So basically, don't miss this part. The interest rate that they are paying in this particular case is 5%. What is happening in the market with interest rates? Well, not necessarily movement in the market, but what is the current market paying as far as an interest rate goes? It's an assumption that you can make. If we're paying 5% and we're issuing at face value, good, the market is 5%. Exactly. There's no discount, there's no premium, the interest rate is not different in the market, it's the same. So we've got the issuance of the bonds. Now, just keep in mind that it's like we're making this really super simple. This is another topic that we go deep into in Intermediate 2, where we get into all kinds of things that go on there. So I just want to make sure I qualify that. We're oversimplifying this, but we're getting you accustomed to thinking in this particular way. So, when we issue the bonds, how much are we getting? How much are we collecting, or how much total bonds are we issuing? Good, $2.5 million, right? That's simply the 25,000 bonds times the $100 per bond, right? So when we issue those bonds, let's go ahead and go down to the, we're getting 2.5 million, okay? So we're collecting the cash and we're recording the bond payable. That's as easy as it gets when you're talking about bonds. All right, then they ask you for the first interest payment on December 31. Okay, so again, make sure you're clear on the date. So what time period are we covering for this interest payment? 1 year. Okay. Now that, just realize though, in this particular case, we already decided that we were paying $5 per bond. Okay? It's 1 year later, so the amount that we're going to pay out per bond is $5. If this question had something like, we're going to pay out interest every 6 months, then we wouldn't be paying $5 per bond. We would be paying how much? Because remember, $5 is for the whole year. So if we're paying the interest every 6 months, we would be paying $250 per bond. Okay? So make sure you're catching little nuances or anything like that. So it's $5 per bond times, to get the total cash, $5 per bond times 25,000 bonds, right? So there's our $125,000 payment, okay? Every bit of it goes to interest expense. That's not always going to be the case. And the amount of your cash payment. The biggest thing here is this. When you start issuing bonds, so again, this is the simplest example possible. When you start issuing bonds at a premium or a discount, one, calculate the amount of the cash payment, stated interest rate times, face value times number of bonds, right? Nail that down first. That's the actual cash payment. Then we're going to have some amount of interest expense, and then we're going to allocate some portion of the discount or the premium, okay? All right, so there's an nice and easy one. All right. Okay, let's take a look at this one. Now this one, they're not actually going through the journal entries. They're actually taking you right straight to what would the balance sheet look like. Okay, but now in this one, notice what's happening. We've got E-Tech Initiatives Limited plans to issue $500,000 of 10-year 4% bonds. So in this particular case, they didn't give you stated rate. They just simply told you the total face value of all the bonds. Okay? Interest is payable annually on December 31. All of the bonds will be issued on January 1 of 2025. Okay? So then they're asking you, show how the bonds would be reported on the January 2nd, 2025 balance sheet if they are issued at 97. So again, remember, the way that we actually state bond issuances and values in the marketplace is we state them at the percentage of face value, okay? So if they were issued at 97, that simply means that we issued $500,000 worth of bonds at 97% of what the face value is. So they were issued at $485,000. Is everybody with me? So we issued $500,000 worth of bonds. We received $485,000 for those bonds. So how much is the discount? How much? $15,000. Okay, so it's just simply the difference between the two. Now, the other thing is that this $485,000 is what we call the carrying value of those bonds. So, no matter what, when we issue bonds, let me do it this way, because again, a picture's worth 1,000 words, right? Or a journal entry's worth 1,000 words. Okay, so in this particular case, we collected cash of $485,000. Okay, that's just simply face value times the percent. Okay, then the other piece that we have to record is the bond payable. Okay, and the bond payable is going to go on the books at $500. So we're going to have a credit for $500 on that journal entry. And then to force this journal entry to balance, we need $15,000 on the debit side, and that is the discount. Okay, so here's the discount on bonds payable. So there was the original journal entry when you issued these bonds. The very next day, notice what's happening. The very next day, we're going to report bonds payable at $500,000. We're going to record the discount at 15, and the carrying value is the amount that we issued them for. That was the amount of cash that we issued. Okay? Now, let's talk about this for just 1 second. Does this sort of presentation look a little bit familiar to you? We've seen something else that sort of presents this way. What is it? Can you think of it? How about like a fixed asset with an accumulated depreciation tucked in there, right? So when you're thinking about this carrying value, this is equivalent to net book value if we were dealing with an asset. You with me? So again, the big things here is that, again, we remember, we went all the way back to chapter 1. The concepts and the overarching presentation factors are still in play. The only thing that's different here is we're dealing with debt rather than dealing with an asset. Okay? All right, let's see. All right. Let's take a look at the next one. All right. So here's the next one. Okay, here's the next one. All right, now just realize nothing has changed up here on this bond issue, right? The only thing that has changed is they're issuing at 102. All right? You with me? So, don't go back to number 19. I'm going to go back to number 19. So, when in this particular situation, we've got the same exact bonds, 10-year, 4% bonds, we issued at 97. So, what are the market rates doing? Are they higher, lower, or the same than 4%? They've got to be higher, right? Because our bond's not looking too good. We had to issue it at a discount, right? So now, in number 20, if we have the exact same situation, the only thing that's changed is now they're issuing at 102. What assumption can we make about market rates? Higher or lower than 4%? Lower, because now our 4% bond is looking awesome. A couple of years ago, that could have very well been the case because interest rates were at near zero, and if we had issued a 4% bond, people would have pounced on that like crazy, okay? So, if they issue at 102, we simply take the 500,000 times 1.02. So they're going to issue at 510, all right? So now, on our journal entry, when we issued them, cash is going to get 510. How much is the bond payable going to get? 500. That doesn't change. Which then means, what's going to force that journal entry to balance? A $10,000 credit at this point, and that's going to be called the premium. All right. So then they ask you for the presentation. So again, now in this one, the day after we issue these bonds, the carrying value is now $510,000. How we doing? Okay. All right. Let's take a look at number 21. On February 6, 2024, there was a quoted bond price of 130.03. Now stop and think right there. Is that bond looking good to everybody or bad? If they're willing to pay 30% more for it, it must be looking really good, right? Okay? For Tough Motor Companies, 7.45% bonds. So think about what's happening here. Okay? What's probably happened is since Tough Motor Company issued that 7.45% bond, have interest rates gone up or down? Down, like probably pretty significantly, if people are willing to pay 30% more for the face value of the bond than its stated rate. And then it's going to mature on July 16th of 2034. All right? So then it says, were the bonds listed at a discount or a premium? And they're listed at a premium. Good. Does this mean the market interest rate for comparable bonds was higher or lower? It's lower. Okay. How are we doing? So again, don't miss out on the fact that it's like bond interest rates and what the market rate is doing tells you a lot about what's going on in the system. Let me just tell you, you're going to love me when you're sitting there in your senior level strategy class and you're having to write a 50-page paper on things, because this is the kind of stuff that makes all the difference in the world of whether it's a 50-page paper and, you know, you're having to whittle it down, or it's a 30-page paper that you got to come up with 20 more pages of stuff. Okay? All right. Let's take a look at the next one. On January 1, we've got Applied Technologies Corporation issued $500,000 in bonds that mature in 10 years. The bonds have a stated interest rate of 10%. When the bonds were issued, market interest rate was at 10%, so they should be issuing at premium, discount, or face value. Good, face value. The bonds pay interest once per year on December 31. Okay. Item number 1 says determine the price at which the bonds were issued and the amount that ATC received at issuance. So if they issued at face value, how much did they receive? $500. Okay. All right. Then requirement 2 and 3 says prepare the required journal entries to record the bond issuance and the first interest payment. Okay. So if they were issued at face value, how much cash did we receive? I know it's the last day of class. 500. Okay. Then, so bless you. So then there is your cash amount that you received, $500,000. Bonds payable goes on the books at $500,000. Now, one of the things that I've kind of assumed up until this point, but bless you, man. So then remember, here's one other thing to remember. When we are issuing bonds, remember that the bond payable amount that is going on the books is always going to be the total amount of face value. What we are saying there with face value is simply this. So if we're let's do it this way. If you are issuing a bond to me and the face value of that bond is $1,000, what you are telling me is that you are going to pay me interest at X% per year, and then on the maturity date, you're going to pay me back that $1,000. Okay? So when we book this $500,000 worth of bonds payable in this case, this is the liability that will stay on the books until we either retire the bonds early or the maturity date of the bonds, when we pay back everybody that $500,000. Okay? So something to make sure that you note there. And then they're asking for the interest payment. So how much are we paying per bond? Well, let's see. They don't tell us per bond. How much is the interest payment every year? $50,000, right? It's just simply the face value of $500 times the 10% interest rate, and we're going to pay $50,000. Okay, so $50,000 of cash goes out. Again, remember, that cash payment there is always face value times stated rate. That does not change. The interest expense and the allocation of the premium or the discount is what changes. If we've got a premium or a discount. All right, how are we doing? Okay. All right. We've got Grocery Corporation received $300,328 for 11% bonds issued on January 1 of 2024 at a market interest rate of 8%. Now don't read any further. What can we assume from that sentence? The bonds issued at a premium, discount, or face value? Premium, how do we know? No, I don't want you to, that's what I said, don't read the next sentence. What can we use in sentence number 1, what can we use to know that they issued at a premium? The interest rates. Because if market is at 8, our bonds are paying 11, then that $300,000 includes a premium amount that folks were willing to pay for that bond. Now, when we read on, the bonds had a total face value of $250,000. Well, we just verified what we already anticipated. Okay, so it's always nice to have a double check. Let's see, face value of $250,000, stated that interest would be paid each December 31, and stated that they mature in 10 years. All right, so prepare the following table for each account by indicating whether it's reported on the balance sheet or the income statement, the dollar amount by which the accounts increase and decrease, etc. All right, now let's look at this one. Okay, so let me just say again, I like practicality. That's what you're going to see on the exam. But so this type of question is not something you would see on the exam. Okay, but look at what's happening here. The bonds payable, right? It's sitting on the balance sheet. At its issuance, it's $250,000. So again, every time we issue those bonds, regardless of whether it's a premium, discount, or face value, the amount that goes on the books is the face value. Okay? And when interest is paid, there is no change. The only time that $250,000 changes is when we pay back the bondholders. Okay? Then you've got discount on bonds payable. Well, you would find on the balance sheet. In this particular case, there isn't a discount. Again, they're testing you to see if you really understood what you were reading up there. There is no discount, and when we make the interest payment, there is no change because there is no discount. Okay? Let's look at the interest expense. Okay? Now, the interest expense, that's going to show up on the income statement, and when the interest is paid, it's going to increase. Okay? So watch a couple of things here. We're going to actually walk this through just a little bit. Okay? Then you've got the premium on the bonds payable. Okay? So the premium on the balance sheet is going to show up at $50,328. Now again, right after this bond is issued, what's the carrying value? Good. It's the $300,328. It's both the bond payable and the premium on the bond payable, right? So just like here,
After it's issued?
right after it's issued. The carrying value is going to be the bonds. Well, and let me point this out. So when you issue at a premium, right after the bond is issued, the carrying value with a premium is going to increase the carrying value. If you issue at a discount, like we did over here in this question, the carrying value is lower. So remember, you add a premium to get to carrying value. You subtract a discount to get to carrying value. How we doing? Okay. All right. Let's look at this one. January 1, we've got Innovative Solutions Incorporated issued $200,000 in bonds at face value. Doesn't get any easier than that. Bonds have a stated interest rate of 6%. The bonds mature in 10 years and pay interest once per year on December 1 or December 31. Here are, let's start with that one because I totally forgot how that they actually retired this one early. So let's talk about how this one works, right? So nothing's changed here. We issued the bonds at face value. We've got the $200,000 in bonds payable, $200,000 in cash. 1 year later, we need to make the interest payment. The interest payment is just simply the $200,000 times the 6%. That gets you to your $12,000. And again, remember, when you're taking that interest rate times the stated rate, that's the cash number. Then the interest expense and any premium or anything will then be taken into account. We're going to look at some of those here in a minute. All right, so then look at what happens here. It says early retirement. Okay, then we've got an early retirement on the bonds. It says assume the bonds were retired immediately after the first interest payment at a quoted price of 101. All right, so think about what's happening here. If we're a company and we issue bonds, and at some point, let's walk through like a real world situation here. Let's say that we issue bonds to build a new manufacturing facility. So keep in mind that one of the things about this whole bond issue, they're keeping the numbers very small just so you can actually sort of grasp that before you move on to bigger numbers. But just understand that when we're issuing bonds, this takes a lot of time, effort, energy, expense, and everything else. And normally a bond issuance would be something more along the lines of like $500 million kind of thing that we're looking to produce, put together, build a new manufacturing facility for a different product, a new product. Let's apply it to real world. So all these tariffs that they're talking about on the news. Does everybody understand what Trump is trying to accomplish here with the tariffs? Okay. What he's trying to accomplish is this, and it's working, by the way, is that all these companies who over the years have moved all their manufacturing to other countries where labor rates are much lower than the U.S., they've moved all their manufacturing facilities to other countries. So when these tariffs go into play, what should those companies do then? Good. Exactly. They want to bring the manufacturing back to the U.S. because they want to avoid these tariffs. So we've got a couple of companies already that they've announced that those companies are bringing some manufacturing facilities to the U.S. So that's going to be kind of interesting. Okay. Well, yeah. Well, one of the interesting things is that, and seeing this also happened a number of years ago, was anybody ever go 85 south, like down through South Carolina? when you get to Spartanburg, what do you see on the right-hand side of the road? Nope, it's not Hyundai. Nope. It's BMW. We lived in Spartanburg when that whole BMW facility was announced. It used to be like tiny, and now it's huge, right? So that's the kind of thing that we're looking at here, is that we're trying to bring, one of the things that has happened in the U.S. economy is that we have become more of a service economy and not a manufacturing economy. So that's one of the things that we're trying to do here. So again, when we're issuing bonds, we're sitting there and we're like, okay, we need $500 million for a new manufacturing facility, whatever it is that we're going to manufacture. And this is the kind of thing that's happening now. So think about what happened. We issue these bonds, we build the facility, and effectively, when we're going to pay off these bonds, the profits and everything that we're making from this new product and this new facility typically will go back towards paying off these bonds. So if this product happens to be just absolutely going like gangbusters, and we are making money hand over fist and the cash is just flowing in, why leave that bond out there where we have to pay interest on it constantly, increasing our interest expense, right? Let's just get this thing paid off. So when you're looking at a question like this, that's kind of there's kind of a story that you can put behind it. So right after this first interest payment, they're going in and they're saying that we're going to retire the bonds. Now, understand though, when we go to retire the bonds, we have, as the bond owners, or as the bond issuers, we have to go back out to the bond owners and we have to pay them market value for the bond. So just like anybody else, we've got to go back out there and we've got to buy them back at market. So the current market price is at 101. So we're going to have to pay more or less than face value to get them back. A little bit more than face value, right? So when we go to buy them back, look at what happens here. Now, before you don't even look at that yet, let me say one more thing. So remember that this functions just like the assets that we had in Chapter 9, okay? It's just we're dealing with a liability. So if you remember, right, well, we had an asset, we depreciated it for some period of time, and then we decided to sell it, dispose of it, whatever, right? That's kind of what's happening here. It's just we're dealing with a liability. So we're getting rid of a liability rather than getting rid of an asset. And it works the same way. So in this particular case, let's start with cash. We had to pay 101 for those bonds, and remember, they were issued at $200,000, so there is the extra 1% that we had to pay to get them back. Okay? Then, the only thing in this particular case that's still on the books is the bond payable, right? Because we issued at face value, so there was no premium or discount that had to come off the books. If there was, we'd have to take that off the books as well. Then we determined it cost us $202,000 to, call it, extinguish a $200,000 debt, therefore costing us more. So notice what happens there. We've got a loss on the bond retirement. Does that make sense? We had a $200,000 loan, effectively, on the books, and to get it off the books, it cost us more than the amount that was on the books. So if it cost us more to get rid of that liability, we've got a loss. If we only had to pay maybe like $190 to get this thing off the books, just depending on what market rates we're doing. If it only took us 190, then it would be a gain. You see it? So it just simply works opposite of the assets. But you've seen this concept before. We bought an asset, we depreciated it for some number of years, we had a net book value. If we received more than net book value, we had a gain. If we received less than net book value, we had a loss. That's on the asset side. On the liability side, now we look at it, if it cost us more to take the carrying value off the books, then we've got a loss. If it cost us less than carrying value to get it off the books, we've got a gain. How are we doing? Okay. All right, there's the little contingent liability. We went over that one last time. Let's see. And I think we did ratios last time as well, right? Let's see. All right, so let's go over to question 30. Okay. Now, in question 30, there's actually, in this particular chapter, I think there's 3 appendices to this chapter. Okay. Understand, the only one that you're going to be held responsible for is appendices A. Okay. Because that's just kind of the easiest one, and we get into the other 2. If you want to take intermediate accounting, then we get into those 2 methods in intermediate. Okay, so let's take a look at this one. We've got Simcoe Company issued $600,000 worth of 10-year 5% bonds on January 1 of 2024. The bonds were issued for $580,000. Interest is payable annually on December 31. All right. So here it says, notice, we're using the straight line amortization and prepare the journal entries to record. All right, so 1, we've got to record the issuance of the bond, and then we've got to record the payment of the interest. Okay? Now, in this one, notice what happens here. We've got notice it says, Simcoe issued $600,000 worth of bonds for $580. So are we issuing at a premium, a discount, or face value? A discount, right? So in the case of a discount, go back to this journal entry here, right? The bond payable that goes on the books in this one is how much? $600, the face value. The amount of cash that we received was $580, and the discount is $20. Okay? All right. Now we've got to record the payment of the interest. This is kind of new. We haven't seen this one yet. So in this particular case, notice what's happening. It's a 10-year bond. Okay? We've got a discount of $20,000 to amortize over 10 years. So how much are we going to amortize it each year? $2,000 a year, right? Okay, so remember, amortization, there is no residual value or anything. It's just whatever the amount is divided by the period. So every year, we've got to take care of $2,000, and we're going to get rid of this discount of $20 at $2,000 each year, and at the end of 10 years, that amount is 0. So here's what happens. How much, let's do this one, how much are we paying out at December 31 in cash? Remember, nail your feet to the floor. How much? $30,000, right? We're simply paying out $600,000 times the 5%, right? $30,000 is the actual amount that we're paying out. So let's start there. Okay. 2, amortize the discount or the premium. In this case, it happens to be a discount. So if that discount is sitting out there on the books with a debit balance in it, to amortize it, we would credit that amount. So now, after this amortization, now it's at 18. We amortize 2 more, and it's at 16, 14. You with me? Okay. So get rid of the amortization, or apply the amortization, right? For the discount or the premium. In this case, it's a discount. Then calculate the interest expense. Okay? Now, we're going to start with just the pure function of how to get this going. Is everybody clear on this journal entry? Because again, now I'm going to go into the whole thing of why. How we doing? Right? Face value times stated interest rates gets us the cash amount. Amortize the discount or the premium, and then calculate the interest expense. Now, think about what happened here when this bond was issued. When we issued at 5%, how was our bond looking? We issued that 5% bond. How was it looking when we issued it? Was it looking good or bad? It was looking bad, right? So the market interest rates must have been higher or lower than 5% when we issued. Higher. You with me? Okay, so at the point when we issued at 5%, market rates were higher than 5%. So that amount of the discount sort of over time, as we amortize it, increases that actual interest rate up to the market rate of when we issued. So effectively what happens there is, in this case, and we can actually estimate, let's see, if we did let's see, hang on. So effectively what's happening here is market interest rates must have been somewhere around maybe like a 5.5-ish. Okay, so notice what happens, right? If we take $30,000 plus the 2 to get to $32,000 worth of interest, we're paying $32,000 worth of interest on $600,000 loan. Which then, if you calculate that, gets us to about a 5.3. But again, because we're doing straight line, it's not exact. Okay? So when the interest rates were higher when we issued, this is where that gets reflected in how much interest expense we have to record. It does not, and I can't overemphasize this, it does not affect how much cash we pay out for interest. That remains the same. I know, this is where everybody kind of gets that weird look on their face. It's fine. Nope, there are no stupid questions because somebody else is probably thinking it. What you got? Okay, watch what's happening here. All right, you with me on, go back to the day we issued, right? We issued $600,000 worth of liability for $580, right? So our bond was not looking too hot, right? Which means market interest rates were higher than what we were issuing at, right? Now, remember that what happens, and again, I'll attack it from all these different ways, so maybe something will click. So understand, right after we issued, what was the carrying value of the bond? Not interest. Don't think interest. Ignore the second journal entry. The carrying value of the bond the day we issued was $580, right? Okay. Is everybody with me? So right after we issue, the carrying value is 580. On the day that this bond matures, how much do we have to pay back the bond owners? The full face value of 600, right? So on the day we issued, we've got $580,000 as the carrying value. On the day that these bonds mature, we need to have 600 on the books. So look at it that way. We are slowly reducing this bond each year. We're slowly reducing this discount, increasing the carrying value up to $600,000 on the day that the bond matures. That's another way to look at it. Okay, let's look at it this way. Let's look at it this way. Again, I'm going to hit on something here in a minute. I love the challenge. Think about this discount as prepaid interest. You got it? So if you think about it, the fact that we had to issue at an amount lower than the actual face value means that this $20,000 is effectively prepaid interest. It's just that we didn't receive the $20,000, but it can function like prepaid interest. Well, if it's prepaid interest, remember, we've got to then, just because we pay the interest in the first day that the bond is issued, doesn't mean that that's when the interest is incurred. Make sense? So now what we're doing is that discount allocates as additional interest, thereby increasing the interest expense up by that amount that we're allocating each year on the prepaid interest. How's that work? Okay? Yes. Flip your perspective. We're issuing the bond. Actually, no. If you're the investor, okay, think about it like this. If you're the investor, you paid. Let's think about this one. And let's look at it as one bond. Okay, so we've got a $600,000 bond, right? We bought one $600,000 bond, and when we bought it, we only had to pay $580,000 for it, right? So we are going to receive the cash payment each year plus that little bit of discount that we took when we bought that bond is actually going to increase our interest revenue on our end as the investor. So when we get to buy an amount, because again, remember, the $600,000, what that is that's the guaranteed amount that we're going to receive on the maturity date, the face value. As the investor is looking at it, that's what the company. Mm-hmm. So effectively, yeah. Yes, in 10 years. Mm-hmm. Yeah, but remember, as the investor, we're getting the $30,000 each year, but we didn't have, but we paid $580 for something that we're going to get back $600 at the end. No, it's more like prepaid interest. Okay, I'll give you one that you might be able to actually appreciate, right? So when we go, let's flip the perspective, right? When we need to go to the bank and we need to finance our mortgage, right? Finance our home, right? There's an option where we can prepay some of the interest, and that knocks down the interest rate just a little bit. But again, we prepaid that interest. So on some level, that expenditure on day one means that we have to pay less in the future. You with me? But that prepaid amount that we pay on day one actually kind of increases our interest rate just a little bit. Yeah, but it might be the kind of thing where, maybe we pay 1 percentage point of interest on the loan, 1% of the loan, but it knocks it down 0.5% on the ongoing interest payments, right? But because we prepaid some of the interest, maybe it knocked it down to 4%, but that prepayment of the interest actually knocks it back up to about a 4.2. Because we really are having to allocate the full expense. All right, let's look at another one. All right, this one is a premium. Okay, so now we're back to Grocery Corporation received that $300,328 for 11% bonds, right? Market interest rate of 8%. Ours were paying 11. We knew it. We got to charge more for those bonds than face value. The bond had a face value of $250. So again, flip your perspective. From the company's point of view, we got we borrowed $300,328, and we only have to pay back $250. So now that lowers our interest rate. So when we've got a discount, it increases our interest rate. When we've got issue at a premium, that decreases our interest rate. So when we issued at the premium, again, we received the total amount of the $300,328. Bond payable goes on the books at $250, face value, every time. Then, in this particular case, we've got the premium. So on the day that we issue the bonds, right, the carrying value is higher than the face value. Okay? Now watch what happens. When we make that interest payment, and again, remember the cash amount of that interest payment is just simply the interest rate times face value. Then we allocate or amortize the premium. So in this particular case, let's see, where'd it go? It's also a 10-year maturity. So we take the $50,328, divide that by 10. There's our 5032, and they're just rounding up to 5033. Now we're going to slowly get that premium off the books, but notice what happens. That decreases our interest expense because on the day that we issued, we got more. How can I say this correctly? We took out a $250 loan, but we received $300,000 for it. Okay. So in this particular case, the interest expense gets lower. How we doing? All right. Let's see. Okay. All right. This might help. Watch what happens here. On this one, notice it says on January 1, when the market interest rate was 9%. Seton Corporation completed a $200,000 8% bond issue for a 187. All right, now stop and think. 187, we received less for the bond issue than face value, so we issued at a discount, right? So now it's like, okay, we got less for it. Now our interest expense is going to be going up. They're going to pay interest each December 31, matures in 10 years. Seton amortizes the bond discount using the straight line method. All right. So there's your bond issuance. Again, every single time bonds payable gets face value, the amount of the cash, record that back into the amount of the discount or the premium. Okay. Then we're going to record the first interest payment. So again, on that first interest payment, hang on, it was 8% times the 200,000. That gets us our 16. So again, face value times stated rate always gets you the cash payment. We then amortize that discount. So in this particular case, we're still looking with a 10-year bond. So we allocate 1/10 of that discount each year, and then that increases our interest expense. Okay. Let's see. Oh, yeah. The bond amortization schedule. All right. Now, this could be a little overwhelming. Don't let it be. All right. So let's look at what it's telling us. And this starts to get, I hope, the visual of it starts to make sense. So, on the cash paid, again, I cannot say this enough. This is a bond amortization schedule. If you hit the submit button and then go back into the answer, yeah, don't even try. Don't try to get all this information down. Okay, if you hit the submit on this practice assignment, you can always go back in and just click on show answer. Okay, and you can see this. Okay, so I'd rather you engage in the conversation. So you've got cash paid. Remember, that doesn't change. Face value times stated interest rate gets us the cash payment. So notice, that's the exact same thing every single year. Okay? When we issue, so that's the first column, all right? Now, let's go to the first row. At the beginning, the bond payable was $200,000, right? The discount was the $1,287,837. That gave us a carrying value of $187,163, right? Now, couple of things. So there's the cash paid. That's the same every single time. The bond payable column. Let's do one more thing. Let's see if I can move this down just a little bit so you can actually see. That better work? Okay, maybe that's a little better. All right, but understand, at the end of year 10, right? In year 10, we pay it off. So there's the end right after the last payment. Okay, we have 0 in bonds payable. Okay, we amortize the discount. So we took that $12,837. We got a 10-year bond. We're allocating $12,084 for most every year. And then notice in the last year, that's where we adjust for that little bit of over allocation in the first 9 years. Okay? We simply, because this one happens to be a discount, remember, we prepaid that interest, so now we're allocating the interest within the period in which it is incurred. So again, that goes all the way back to chapter 1. Expenses are recorded in the period in which they are incurred. Okay, that increases the interest expense up to the $17,284, and again, adjust that last column. But then look at what's happening here. In the discount column, right? We start with the $12,837. Each period, we're simply subtracting the $12.84 of the allocation to constantly bring that number down. So then, right after that last interest payment, there is a 0 sitting there in that discount. But there's 200 sitting in the bond payable, indicating, so right after the last interest payment in year 10, we now have to pay off that $200,000. So I wish they would kind of go one line further, but they don't. You with me? So we allocate that whole entire discount, and then notice what's happening here. In the carrying value column, we're simply taking the bond payable minus the unamortized discount to get to the carrying value. So notice what's happening there. When we issue at a discount, the carrying value starts low, and as we allocate, the carrying value increases up to the amount that we're going to have to pay on the maturity date, which in this case is the $200,000. If we were dealing with a premium, carrying value would start high, and as we allocate that premium, the carrying value drops down to the face value. There's a really nice visual in your textbook and in those PowerPoint slides that show you what's happening there. How we doing? All right. So there's, all right, so that's all the static exercises. So your brains don't explode. Let's go ahead and let's take our 15-minute break. Let's be back in here at, what, 10:47?